So, have you felt it lately? This weird disconnect in the market. It's like we're living in two completely different worlds. In one, you see stock prices just blasting off, heading for the moon. But in the other, the global economy seems to be flashing all kinds of warning signals. This split is one of the biggest paradoxes we've seen in years, and we're going to unpack it right now.
And this is the million-dollar question, isn't it? It's the central puzzle that has so many people scratching their heads. On one side, you've got major stock indexes hitting record highs, one after another. But on the other, there's this steady drumbeat of news about weakening fundamentals. How can both of these things possibly be true at the exact same time?
And this right here, this slide just perfectly captures that split-screen reality we're all in. On the left side, it is an absolute party. Stocks are soaring, and it's all being fueled by this massive wave of excitement around AI. But then you look to the right, and it's a totally different story. We're seeing a global economic slowdown, inflation that just won't quit, and governments drowning in debt. It really is like watching two different movies at once.
All right, so let's really dig into this paradox. What are the actual economic red flags waving here that make these crazy high stock prices feel so, well, so puzzling and, potentially dangerous for a smart investor?
Okay, so what we're looking at is basically a triple threat of global headwinds. First, there's a synchronized slowdown. This isn't just one country. The economic engines in the US, Europe, and the UK are all kind of sputtering. Second, we've got this stubborn inflation, especially in services, and that's really putting the squeeze on company profits. And third, government debt is at historic highs, which could mean interest rates stay elevated for a long, long time.
So you hear about that stormy economic forecast, and you got to ask, where's the biggest danger actually lurking? Well, the analysis here suggests it's hiding in plain sight. Seriously, right at the very top of the US market. The real risk seems to be the exorbitant price investors are paying for just a handful of dominant companies.
You see, this whole market rally is, well, it's incredibly narrow. It's not like everything is going up together. Nope. This is basically a rocket ship being fueled by just a handful of those giant mega-cap tech stocks, and they're all supercharged by the AI hype train. And man, all that excitement, it comes with a really hefty price tag. The S&P 500 is trading at what's called a forward price-to-earnings ratio of 22.6. The easiest way to think about PE is like a price tag for a stock. It tells you how many dollars you're paying for just $1 of a company's expected earnings. So a higher number means a more expensive stock. Now, 22.6 might not sound huge, but let's put that number into some context. And that 22.6, I mean, look at this. It's a whopping 36% higher than its long-term average. And you have to ask yourself, why does that matter? Well, history has a pretty clear answer. It tells us that when you buy it to the market at valuations this high, you often end up with pretty disappointing or sometimes even negative returns over the next decade. And this is where it gets really wild. That high average we just talked about, it's kind of a mirage. The top 10 companies alone make up a staggering 35% of the entire index's value. Just 10 companies. This is a level of concentration we haven't seen since the dot-com bubble, and that's a historical parallel that should really make any investor take a second look. The performance of the entire US market is pretty much resting on the shoulders of just a few giants. That's a huge concentration risk. This brings us to one of the most important ideas in all of value investing. It's called the margin of safety. Think of it like this. You find an amazing designer coat, but it's on sale for half price. That discount, that's your margin of safety. It's your buffer in case things go wrong. But in today's super hot US market, for a lot of these big stocks, that margin of safety has just vanished. People are paying full price or even more. Okay, so if the main party is completely overcrowded and everything is way too expensive, what do? Simple. You leave the herd behind, and you go hunting for value where nobody else is looking. And wow, this table just lays it all out crystal clear. Just look at the valuation gap here. The US is trading at that pricey 22.6 times earnings. But meanwhile, Europe is at a much more reasonable 15.8, and the UK looks like an absolute bargain at 12.8. That's actually cheaper than its own historical average. This suggests there are world-class companies out there at a discount, but you've got to be willing to look abroad. But here's the thing. Just being cheap isn't enough, right? We're not just looking for bargains. We're looking for great businesses that are on sale. And that's where this idea of an economic moat comes in. A moat is just a durable competitive advantage, like a super strong brand or powerful network that protects a company from competition, just like a real moat protects a castle. The goal is to find companies with these wide moats that happen to be trading for cheap prices.
And this hunt for value, it's not just about looking overseas. There are actually some really promising hunting grounds right here in the US. You just have to know where to dig. Small cap stocks, for example, are trading at a big discount to their bigger cousins right now. And then you have entire sectors like energy and real estate that have been totally overlooked by the market, which could mean there are some hidden gems waiting for a patient investor.
Okay, we've laid out the problem, we've spotted some potential areas of opportunity. Now let's pull it all together into a clear, actionable playbook, a strategic framework you can actually use to navigate this tricky environment.
So how do you actually play this? How do you navigate a market this tricky? It really boils down to 3 key things. First, and this is a big one, you have to resist FOMO, the fear of missing out. Chasing hot stocks is a surefire way to get burned. Second, do your homework. Just because something's cheap doesn't automatically make it a good investment. You still need to find quality businesses. And third, keep some cash on the sidelines. Cash is your superpower when the market eventually panics and opportunities are everywhere.
And I want to leave you with this final thought, because it just perfectly sums up the value investor's playbook for today's market. In a world that is so obsessed with greed and chasing the next hot thing, the greatest virtues are going to be patience, discipline, and the courage to actually use your capital when everyone else is running for the exits. Thanks for joining me. Now, just a quick heads up, all the analysis we talked about is based on public information and it's for educational purposes only. It is not investment advice, so please always do your own homework before making any big decisions. And hey, if you want to keep track of the market's temperature yourself, you can check out the Buffett Indicator app on the iOS App Store. It's a great tool for getting daily updates. Also, if you enjoyed this and want to go even deeper on topics just like this one, you can find our full discussions by subscribing to Deep Value Investing on Apple or Spotify podcasts. We'd love to see you there.